Hi everyone, and welcome to another episode of Market Intelligence TV. My name is Matt, a recruiter and a researcher over the last decade. I spent my time both in the corporate and the non-corporate world. I've joined forces with a special individual, Imre. Imre is a fantastic person, and I'm sure he's going to give a little bit of an introduction just very quickly again, just to see in terms of what he does. Imre, how are you?
Hey Matt, good to be here. Always happy to have this chat.
Yeah, good stuff. So, yeah, give us a quick introduction very quickly again. 30 seconds just about
Ah,
yourself, and
ah,
we'll get into it.
hate talking about myself, but all right.
Uh,
I'll give it a go. Yeah, so been trading professionally for just over a decade now. Um, this is what I dedicate the vast majority of my day to, is trading. Reallocating balances in the portfolio, working on different positions, exploring different strategies. I do this alongside my trading partner, Andy Krieger. Andy is frankly, one of the greatest traders of all time, in my opinion, renowned for how aggressive he was. And although his public trades, are massive, talking to him privately, I can tell you there are trades he's put on other than that famous one where he crashed the New Zealand dollar for $300 million in 1974 that are far bigger. Our approach to trading is a combination of systematic frameworks, particularly on the option side. This is something that we're continuously evaluating and changing. And that trading approach is a market neutral one, which is something I'm going to want to discuss in greater detail later on, because I don't think that's something that a lot of traders are familiar with in the FinX space. My own trading style is a lot more discretionary. I look at daily trends, I look at macro trends. I'm a day trader and a swing trader, primarily on the swing trading side, and very, very happy to be here, as I said.
Yeah, awesome. Listen, I know that today's going to be a little bit interesting, given the data that's about to come out. And we've got a couple of dogs as well barking, so if you hear that, then yeah,
Oh yeah, sorry
part
about
of me
that.
working from home. No, it's all good. I've got a dog as well, so yeah, if she starts barking, then it's what it is. Part of the beautiful nature of working on being at home. So yeah, listen, let's get straight into it because there's a few things to talk about from the data perspective. Obviously, we're sort of back to normal-ish in terms of receiving data from different governments. Obviously, US is back fully functioning, so data is coming out a little bit late, but better late than never. So yeah, I mean, to start the trading week on Sunday, nothing really came out that was of interest. From a Chinese point of view, they're sort of stagnating a little bit in a contraction on the non-manufacturing PMI and manufacturing PMI. Nothing really to talk about. Aussie and New Zealand data again, nothing really to talk about. I really wanted to pay attention. The only thing that sort of on Monday as well, I really want to talk about very quickly is the Japanese capital spending has dramatically dropped. And that's for a number of reasons. Yields rising at a pretty catastrophic rate, which we can very quickly talk about later on in the video, as well as just the overall loss of confidence in the Japanese economy. I think it's accelerating. I mean, have you seen that recently, especially over the last two weeks, Imre, yourself?
Yeah, absolutely. I mean, those yields, they are surging, are they not?
Yeah.
And that, I don't think the vast majority of like the online trader population understands how terrifying that is.
Mm.
Japan has a tremendous amount of debt, a tremendous amount of debt. They do have a tremendous amount of savings as well that can help offset that. But other than the debt that Japan carries, they're also one of the largest creditor nations in the
Yep.
world.
Yep.
Um, so when you have issues with the Japanese economy, and I was just talking to Andy about this. His view is that it's inevitable that the BOJ will have to raise rates.
Yep.
And if you look at the interest rate differentials that the market is starting to price in as far as the spread goes between Japan and other G10 FX, yes, there is a ways to go between, say, the US and Japan, but or sorry, US, US and Japan still, Japan and Australia. Yes, that is true, but that spread is getting narrower and narrower and narrower. And the only
Yeah,
thing that's left is for the BOJ to come out with a hike. But the BOJ also needs to know, I mean, they do know that they can't just unleash that shock on the market, given how much short yen is out there. So they have to really signpost their way through this, I think. And they're really going to have to do some hand holding for the market as best as possible. Now,
yeah,
the other thing I can say about the Japanese, especially for their currency, is that they are coordinated, meaning that there are planned discussions at the highest levels of industry and government on how to manage a cohesive national currency policy, right? So you have these massive pension funds, you have these massive exporter multinational corporations, and I don't want to say that they're in cahoots, like colluding on manipulating the currency, but there is a cohesive national plan around that. And if,
yeah,
if that plan shifts, it could unleash all hell on the global financial economy. And
yeah,
if I'm thinking of black swan events that may or may not be around the corner, a
yeah,
surging yen is starting to become an interesting theory. And I know we've talked about this before, Matt, and I
yeah.
know you've said, hey, I don't really see a circumstance anytime soon in which the yen could strengthen. And I'm not saying this is right around the corner, but I do believe that there will be a yen tsunami of sorts at some point in the not too distant future.
Yeah, I agree. Listen, and sort of just adding on to the fact that, the BOJ has to essentially let everyone know that they are going to raise rates in order to minimize the impact on the market, purely because of the fact that the moment they start raising rates or start raising rates more than or the market anticipates, then we are going to start seeing a lot of trouble, and the yen appreciation is going to go through the roof. I mean, later on when we go into charts very quickly, we can look at the euro versus Japanese yen, for example, and where it's at the moment. It's at insane levels in terms of how quickly yen depreciated. We haven't seen those moves in years, or in fact decades. Last time I've seen those kind of moves when euro got depegged from Swiss francs. So not as catastrophic how quickly it dropped, but yeah, the devaluation of yen has been spectacular, and obviously, yeah, it's great for exporting and so on and so forth, but for importing and for the overall health of the economy, yeah, it's interesting nevertheless. But we're going to see from Ueda, or however you want to pronounce it. Yeah, he's going to bring out statements probably weekly just to say, listen, we are going to raise rates, yada yada yada, and yeah, hopefully the market's not going to react as much. We'll see. In terms of China, again, as I said, on Sunday pretty much came out that they're back in contraction ever so slightly. Shock horror, nothing really of interest there. Europe is rebounding a little bit, which is great to see. Then obviously UK, nothing really of interest. The money supply is still very high, especially on the year-over-year side. Mortgage approvals are falling. Again, shock horror there. Lending is dropping because of obviously tighter credit conditions due to BOE rates are, I think, the highest in the world right now. Maybe in the G7 anyway. I think BOE is the highest, right? 4.25.
Yeah, I do believe you're correct. I'll
Yeah.
defer to you though.
Yeah, I think it's 4.25 or 4%, way higher than anyone else at the moment. So yeah, we're just going to see how that plans out. And then from the US, manufacturing, yeah, it's still in contraction, has been in contraction for God knows how many months now. It's getting kind of funny at this point. I call it a meme, really. When are we going to see manufacturing rise again, given that US is a service-based economy now? Is what it is. The good sign is the prices are not accelerating as much as expected, which is a bonus, I guess. But yeah, apart from that, nothing really to add. What else I can say in terms of Tuesday? Nothing really happened. Euro stagnant in terms of inflation, so nothing really there. Unemployment is rising, which is something that the European Central Bank will look at, especially like Lagarde. She likes to follow the Fed, basically copycats. Whatever Fed does, they do, and vice versa, pretty much. Um, and then Wednesday, nothing really that I sort of spotted. Everything within sort of norms. Haven't really seen anything that was really interesting, apart from maybe the Aussie GDP. Lower than expected in terms of the raise, which is kind of surprising given that a lot of the Aussie market is based on banks and mining. So that's going to be something that we're going to have to pay attention for. But yeah, any of these statistics that pointed out, well, the only ones were just the US data. ADP again, contraction by 32K, supposed to be up by 5K, and then we had a 5K revision up higher. So yeah, the economy is slowing down pretty dramatically in terms of employment. We've seen it everywhere. AI is taking over, which is obviously not great. For the people that can be easily replaced by AI. It's going to be a trend that's going to be happening. I mean, what are your thoughts on the data that you've seen from ADP point of view? Are you surprised or not at all?
No, not surprised at all. The interesting thing to me is right next week, obviously, going to be massively important for the market. We're gonna have that Fed meeting, right? And when that happens, I think I'm far less concerned about the actual interest rate decision. Don't want to get too far ahead of ourselves here, but I'm not so much interested in the interest rate decision. I think it's a foregone conclusion that they're going to cut by 25 basis points. But it's more so the statement, and there's a lot of data that is yet to come out. And I think with each passing, and by the way, if you want to know where the market thinks rates should be, they should be at about 3.5% for the US, right? So there's maybe another 25 basis points cut coming after this one, provided that 2-year yields stay around this level. I mean, talk about backing yourself into a corner. Talk about backing yourself into the tightest of corners.
Yeah.
When you have such concentration of investment and hopes and, let's just be honest, vibes in one very particular sector, I'm not a perma bear, guys. I promise. Like I am not a perma bear,
Yes, you are. Come on. Come on, just
but
accept it.
like this, if this doesn't terrify you, I don't know what to say. Like I don't know what to say. And no, that doesn't mean that we can't have another all-time high in the stock market. Gun to my head, I'd argue that that's more likely than not. But that none of this bodes well in the medium to long term. None of this bodes well. This is really scary to me. And I've said this before, I've never been as defensive as I have been in my career as I am now. And for, full transparency, I didn't have a real reason to be defensive in my career up until this point, unless you want to count 2022. I mean, I really started, my first trade was in like the summer of 08 or 09. I can't remember which right now. And I didn't start trading professionally until the 2010s. So I haven't had to deal with a full-blown financial crisis the way that we saw during the GFC, the global financial crisis. But I will say, I thought the bubble had burst in 2022. All right. So I was fully outright wrong on that. Was able to pivot relatively quickly as we got closer to the new year. I think it was December 2023 or so that I said, okay, things are flipping. I'm not throwing in the towel on this one yet. I'm looking for that new all-time high, just to be clear. But geez, after that, the job market terrifies me. I don't see how cutting rates is going to help with that. It's like, if you accept the narrative that AI is playing a significant role here in the job market being really tight, I don't see how cutting rates is going to help stimulate employment, unless you're seeing something different here, Matt.
No, I'm not, to be fair. And I kind of agree with you. When I saw the COVID crash, essentially, I was like, oh, okay, the bubbles burst. company have to liquidate, shut down, etc. And then we've seen one of the most egregious. I don't know how to call it. Yeah, egregious. I don't know. Yeah, egregious pumping into the market I've ever seen in terms of liquidity. Which essentially, instead of a little TNT explosion happening, we've essentially put it into a sarcophagus and put a nuclear bomb instead of a small TNT, and just, hopefully, it's not going to blow up all in our faces. And I think we're starting to see the cracks with companies like Oracle and SoftBank. SoftBank is struggling to get more cash out to loan to those AI data centers. Oracle is struggling in terms of having enough electricity to power those data centers. Then Oracle is also lending that, the money that they have left, the cash flow that they have left, to OpenAI and Nvidia and so on and so forth. So essentially, what's building, in my opinion, is one of the biggest pyramid schemes we have ever witnessed, in terms of just being extremely over leveraged. I thought, 6 months ago we were over leveraged, until I saw how much money is being loaned to those companies, and essentially, the what we are going to receive is as I say, a ticking time bomb that is going to blow up in our faces. And the energy part is going to be the catalyst that's going to blow it all up, because right now data centers are in this dream. Yeah, in the dream, essentially, in this trance that, they can just pump out more data centers and more compute power, so on and so forth, and we're gonna get energy from from where exactly? Where, we haven't been building nuclear reactors because everyone wants to go, net zero for the carbon emissions. Nuclear was too expensive, or not too expensive, but too dangerous. So they were looking at alternatives like wind and solar, and they're all terrible alternatives. Don't produce enough, nowhere near enough power that we need. Obviously, the population is much more concentrated in big cities, so obviously that puts strain on the infrastructure that we have. The infrastructure is, 60, 70 years old in some cases, and we have seen the cracks, right? CME breakdown, Cloudflare breakdown. Um, and I think we're going to see many, many more of those soon, right? And you can blame it on cooling or whatever else, but yeah, I think what we're seeing right now is yeah, dangerous precedent, in my opinion. I mean, what did you think to the CME breakdown when it happened?
Uh, CME shutdowns, like market halts for technical reasons, are not. I don't think they're unprecedented, but they're not common, right?
Yeah,
Uh, I'll be honest, I'm not as knowledgeable as you are on looking into how unsustainable the energy production or the cost or capacity are. But it was, you know, to me, I don't want to go into all the conspiracy theories I've seen floating around. I don't necessarily buy into that one way or the other, but it is interesting that I mean that had a massive impact on the world's biggest capital markets for a not insignificant period of time. It was largely swept under the rug, and I'm willing to say, all right, if that's a one-off, then no harm, no foul. But yeah, to your point, is it actually a one-off? To that, I have no idea. My big question is what happens if energy costs start to go up significantly and start breaking out of the extremely favorable conditions that they have been in this year? If that happens, yeah, then what? That's a very interesting question. So this
yeah,
is all teetering, in my opinion, on a very specific set of market conditions remaining more or less exactly the way that they are. And I just think mathematically that is not just unlikely, but impossible. So the question is when, right? That's obviously the
yeah.
the most important question. And sorry to disappoint, I don't know. But I think that if you if you don't have that crystal ball, which I certainly don't pretend to have that crystal ball, the next best thing to do is being aware of the conditions.
Yeah,
And then the danger is walking that tightrope to the best of your ability, right? So you don't necessarily want to be so bearish that you're full blown short the market now. And again, this is not like trading strategy or positioning strategy. I'm just saying like
yeah,
that's how I'm seeing it. I still want upside exposure, which I do have. I'm just limiting how much upside exposure I can have by virtue of protecting my downside at the same time.
yeah,
So if the market goes ripping higher for another 40% from here without a major correction, then yeah, then I'm not going to participate in that rally as much as I would if I didn't have my hedges on.
yeah,
But if we get some upside, fine, I capture a portion of that. And if we start breaking down hard prematurely, then I have my protection in place, right? So that's I would say argue that's what I would argue is the more professional mindset to
yeah,
all of this. It's being able to think in terms of a sliding scale of probabilities and
yeah,
understanding where reward and risk start to flip. But I'm sorry, in the S&Ps, at least in the futures, we've gone over 40% from the lows in April to the current all-time high
yeah,
without a significant correction.
yeah,
Does that
yeah,
mean that we can't go higher? Of course not. But
yeah,
statistically, is that likely to continue uninterrupted? Also, no.
yeah, correct. Yeah, looking at the statistical data just alone in terms of the rallies that we had, yeah, this rally has been one of the biggest in the entire S&P history, which is kind of mind blowing. Given it just kind of shows, given how much liquidity there actually is on the market. There was just so much worrying, and I was also doom scrolling in April to see, oh my god, the market's really over. But then I started to see that rebound and the volume, that the amount of money was coming in, and I was just saying, okay, well, yeah, there's no way this is gonna continue to go down given how much buying there is in the market. And yeah, here we go. 42, 43% later, we're still we're still kind of rallying, right? We haven't stopped the rally yet. We have gone a little bit sideways for the last couple of days, but we'll get into the charts in a minute. But yeah, kind of crazy in terms of the type of market that we're in right now. And yeah, you have to be extremely cautious in terms of being bullish. But hey, in terms of bears, right? You had Michael Burry essentially, closing his hedge fund recently and going private. And he's one of the biggest bears. He called out the two bear markets that we had. And there's a saying, right? But broken clock can be right twice. And a lot of people saying that, yeah, he is essentially a broken clock. He was right twice out of all those times. He's blown up many more times since then. Whether that's true, I don't believe it. He's a very, very smart guy. But yeah, he's sort of, I've seen his recent tweet saying that this correction that we're going to have might take 32 months, and when it is going to come, people are not going to be expecting it, and they're going to be buying the dips and getting liquidated. And I think that's when we are going to have I'd say a healthy market when that starts to happen, right? Because right now we can see, right, and you'll be able to go into charts very quickly, but every single minor drop, whether it's 50 points, 200 points, 300 points, it gets bought up instantly, right? We have those insane wicks, and both on daily, weekly, and hourly charts. But when we start seeing that cascade fall, and the buyers are going to keep buying, and they're going to get leveraged, and then they start getting liquidated, and it's going to start accelerating. I think that's when we might see that correction, that healthy correction, and then carry on moving forward. Because of Ireland, as long as the debt market exists, where are the rich people going to put their money? In the stock market, right? So yeah, but yeah, let's very quickly get back into the data, because I'll give you the floor when it comes to charts very, very soon. Yeah, export import prices on the US 3.8%, really, really high. Month on month though, it's stagnated a little bit, which is great, I guess. It is what it is at this point. When inflation is stagnating, we're seeing on multiple charts. ISM, not really interest and new orders are rising very nicely. PMI has increased 52.6, which is, the economy from services point of view is growing a little bit. And then ISM services paid, 65. It is falling from the 70, but obviously the prices paid are still accelerating, which will unfortunately push on the inflation numbers as well. Thursday, nothing really of interest that I really wanted to talk about, apart from initial jobless claims. Everyone saw the 191K and they were like, "Oh my god, we're no longer in recession," etc. And we had Thanksgiving. A lot of those numbers will be a little bit skewed due to holidays. I can expect that number is going to have a revision. And then we're going to see, back in the 200Ks from this year moving forward. Well, from December, maybe not because of holidays and part-time work. There's going to be plenty of it, but yeah, we're going to have to see. I mean, were you surprised at the initial jobless claims, or you don't really care what was printed?
You don't really care, just given the period, right?
Yeah, yeah, yeah.
And it hasn't bucked like any trends.
No. Apart from that, what else on Friday today? Yeah, nothing really happened. GDP, quote unquote, 0.3%. I mean, it's whatever. No one really cares. And then we're going to have a little bit more data coming out. I'm really interested to see personal income and personal spending. That's going to be of high interest. University of Michigan data is, no one cares about that. It's skewed for the last 12 months now. And then obviously we're going to get the PCE and CPC numbers as well. That's going to be quite interesting. I think we're going to see a number 3 right here, and I think we're going to see 0.3 month over month. And then I think that's when the market will fall a little bit today. But that's a little bit of my prediction. Educational purposes only. do not take this as financial advice. Hopefully, when the video comes out, we're going to get the data out already. Cool. Right. Let's get into you, Imre. Let's talk about charts. What we're seeing, what we need to see, and give us a quick rundown.
All right.
Floor's yours.
Is my charts visible?
Yep.
Okay. All right. Beautiful. So first thing I'll say is let's just take a look at what's going on here on the short term. And by the way, thanks to everyone that just came to my private little Zoom thing yesterday. It was an open invitation. If you want the recording, just DM me on Twitter and I'll send it to you. The reason I mentioned that is because we covered a lot of important ways of thinking about the market that go beyond just what's the trade setup look like, when press buy, when press sell, right? So what I'm going to focus on here is just the short-term action, and then we're gonna go from micro to macro actually. So on the micro level, what's very interesting is this look below and fail level that I've identified at 68. 63, it worked a treat right on Globex Open. I mean, we really literally looked below there, failed, and then shot up, tagged my first upside target. We tried to build value above 68.76, which is a pretty important level for the day for me, failed to do so, and then started breaking down hard. Now, this look below and fail level has worked once again, but we've made a lower low. Buyers have stepped in, and we're now below the developing value area high for the week. The reason this is significant to me is because if you look at what happened Wednesday and Thursday, it's not too dissimilar a story. We've been in this value area for quite some time now, several days. Every time we've tried to escape, it follows a similar pattern where we build value temporarily, we have a small shoot to the upside, and then we give it all back. Okay, Thursday was a little bit more intense. Here we had that transitionary phase. We went up, we tried to build value overnight in Globex, and then went right before market open, we get the dump. Okay, I mean, doesn't take a genius to be able to recognize this pattern over the last few days. My expectation is that the market is going to be bid from underneath today until we crack below the value area low. That's when I think we start looking at a shift in control for the session, and that opens up the downside. I had a friend who is a trader texted me last night, and he's outlined his expectations for the day, and I said, that's great. I probably am not day trading on Friday. I think the market's going to be really, really messy. I've been absolutely emotionally, physically, mentally drained from day trading. I don't want to say live streamed, but I shared a lot of trades that I took yesterday in particular. And I'm not a day trader, but when the market is in a rotational phase, that's actually when I tend to day trade more often than not, right?
Interesting.
Not so
Okay.
much in a trending market. My options trades take care of a trending market for me, but
Yeah.
it's that choppy back and forth when I tend to be really, really active. And it's frankly, it just takes a physical toll. I was up all night. I think I went to sleep around 3 or 4 a.m. Eastern time
Yeah,
because
I saw
I
your
was busy
tweets.
trading.
I
Yeah. Yeah.
saw your tweets. I was like, oh my gosh.
Um, so I just physically don't have the energy to be actively trading today. I'm going to be watching the market very closely. I'll be looking at Fridays are a phenomenal trading day usually because of weekly options expiry. It's all things I take into account. But yeah, I'm exhausted. So that's the micro view. All right. So long as we can build value above currently that developing value area high and crucially the pivot apex, yes, there is upside to play for today. But now let's start zooming out. So if we start zooming out, we're going to look at this volume profile, which captures the swing from the previous all-time high to that sharp spike low Friday, November 21st, right? And we can see that we have actually the bulk of the volume distribution is in this zone here. Now, I somewhat jokingly called that level like the gates of Thermopylae, and it kind of is, I guess the popular reference would be that 300 movie, but it kind of is in the sense that
Yeah.
if sellers are for real, this is where
Yeah.
this is their last stand. This is that tight
Yeah.
narrow pass where they're fighting off the invading army, and they're probably going to go out die trying, but they might do some damage.
I
Now,
agree.
so keep a very close eye on this level. I think as we're breaking out, people are going to get really bulled up. We're everyone's like probably so ready for that 25 basis point cut next week. Dare I say, buy the rumor, sell the news. I do think we're going to get a very sharp drop on that macro side. Here's what's really interesting. We have this state of balance, right? And
Yeah.
and I'm sorry, but the escapes out of this balance are pathetic. Pathetic. Look at the overlapping nature here. This is not a sign of a strong market. This is more what I would call kind of pushing on a string, right? So for us to get escape velocity out of here, we got to break above 6,900, right?
Yeah.
And we can see that on the anchored volume profile as well. That's kind of where the volume starts to thin out. Until then, I like bulls. You guys have been pathetic sellers. You haven't been really able to get much traction, right?
Yeah.
Where things get spicy is if we break below this high volume distribution right here, right around 68.30. Below
Yeah.
there, that opens up potentially a ton of downside all the way to at least 67.61. And below 67.61, we then have another sharp drop to 67.19. So those are all levels worth considering, all scenarios worth considering. The other thing I want to look at now is the cash market. So if we're looking at the cash market here, we can see this beautiful channel that we're kind of breaking out of, and then we have this contracting pattern here. Contracting patterns from purely a price action perspective resolve one of two ways. All right, one, we can get truly escape velocity at the upper side of that resistance line. Mechanically speaking, what does that mean? What that means is that what was a weak and tepid rally, was in fact an accumulation with buyers gradually stepping up their bids, their limit orders. So they're willing to buy at higher and higher and higher prices. Sellers who have been transacting heavy volume here as well eventually capitulate, and then we see that mechanical break to the upside. I say mechanical because it is a function of forced inventory being released. Okay, now here's the really important thing to understand from an order flow perspective if we get that release. If we get that release, this inventory that's been trapped is going to provide a certain amount of lift. However, continued lift is going to be entirely dependent, not entirely. It's going to be largely dependent. The breakout is going to be dependent on buyers willing to buy at the market. Okay, what that means is buyers are going to aggressively try to lift the offer. And if there aren't enough buyers left to aggressively lift the offer, they are eventually going to roll over, and then they're going to be, exit. They're going to be exit liquidity for short sellers on the way down, right? So
Yeah.
something to keep an eye on, right, is that I'm very, very, very cautious of buying a breakout in this environment. I think you're
Yeah.
much better off buying at discounted prices if you want to play for this further upside. There are
Yeah.
very short-term momentum scalps that you could try, but the
Yeah.
cash market to me is obviously it's going to be similar to the futures, but it does have a slightly distinct personality of its own.
Yeah.
If you want my more granular read of what's happening in the cash market, this area that I'm bounding here with these two black lines, I
Yeah.
would say that was the balance. All right,
Yeah.
that was the real balancing period. I think what's
Yeah.
likely happened now is that we've broken out here. We're pulling back in a very clean pullback so far. We'll see
Yeah.
how today's session unfolds. And if we take out Thursday's highs, then I do think we will see some acceleration. All
Yeah.
right. So within that acceleration, if you are day trading, how I would personally approach it, the playbook that I would like to use would be to enter on very shallow pullbacks and sideways corrections. But
Yeah.
I don't want to be buying fresh highs. I don't think I'd
Yeah.
want to be buying fresh highs,
Yeah. No,
not
mate.
into the gates of Thermopylae.
Yeah, yeah, no, no, no. I get that. I completely understand where you're coming from. My charts very quickly. I'm gonna quickly just show my screen. In terms of, how I plotted out the NQ, because you don't really look at NQ from your side, right? You're more of a SP 500 trader, right?
Yeah, I mean, I look at, I do look at NQ. My personal, and professional focus is on S&P and ES, however.
Yeah, yeah, that makes sense. So yeah, I very quickly wanted to show the US price action, the US 100, sorry, or the Nasdaq price action on the cash side, because I really just like the NQ. It's a little bit more volatile. The moves are a little bit more. I wouldn't say interested. Yeah, yeah, I'd say interested in terms of how the volume functions on the NQ. I mean, yeah, very much. I've got the gates of doom highlighted in a little box. At the moment, we are within the box. From the price action point of view, I haven't really seen any great rallies. Any rally that we've sort of seen has been showing that, hey, there are sellers waiting. We've seen it today at the pre-open. We had the initial up by about 0.2, 0.3%, and then we had that instant flush down at the open, which just means that sellers are waiting maybe for the last little hoorah at that little box that I've highlighted, and obviously, from the volume profile that I've got set up, it's showing that there is, a lot of volume sitting there. So I think it's just going to be a matter of time. I think we are going to need a catalyst to potentially see that all-time highs, or the break of that box. Otherwise, we might see, as I like to call, a kangaroo market until the end of the year, with maybe that last rally push, Santa Rally, that we tend to see, as people rebalance their books and so on and so forth. But yeah, just really quickly wanted to show my little chart on the NQ. But yeah, apologies for the. I do like to use the Fibonacci a lot, purely from the statistics point of view. It's a great little tool. But yeah, I'll swing it back to you, Imre.
Yeah, the last thing I'll say is that when this uptrend does resolve, and like I'm not talking about like the uptrend, I'm just talking more about the uptrend that started on November 21st. What I'm going to be looking for is not sellers really driving the market lower by hammering the bid. I'm going to be very interested to see if bids just simply start getting pulled, right? So what does that mean? Mechanically speaking, if you have sellers hitting the bid, those are aggressive sell orders at the market,
Yeah,
okay? Um, and then there will be buyers sitting on the bid, passive buy limit orders, okay? In a strong, healthy bull market, what you would see is that these sell orders here, hit the bid, they get absorbed, price bounces a little bit, buyers don't follow through, sellers try again to break through here, and these bids reload. They start stacking again, right? So and this is very algorithmic behavior, right? The algos will start reloading on the bid, absorbing all these sellers, accumulating position, and then you get that release of energy. Not necessarily because like a huge aggressive bull comes into the market, but because these sellers start capitulating in mass and it triggers a rush for the exit, right? That's a fairly healthy market mechanic. So what happens though when, let's say we have some sell orders hitting the bid, not like crazy amounts, but a decent amount, but those bids that are here aren't. They aren't. Well, you have a low volume node like here, and if the bids are not here at that low volume node to capture prices as sellers are hitting into them, you're going to slice right through that low volume node, right? So that's the mechanical behavior on the order flow on the tape that I'll be looking at very closely.
Yeah, yeah. As I say, it's going to be very interesting. Especially how this Friday Friday will close. So anything else we'd like to talk about? I mean, I'd love to if you got yields shown on your chart or saved. Yeah, I would just like to very quickly talk about the Japanese yields and where they've headed over the last
All right.
week.
Japanese 10-year?
Yeah, the 30 year. I think the 30 year was the more important one. Yeah, there you go.
All right. So this is a crazy chart, by the way.
Yeah.
Like this is borderline terrifying.
Yep.
And if you don't know, familiarize yourself with why Japan is so important to the global economy. If from the lows of October of this year to the very high, a move of nearly 14% in the Japan 30-year is wild.
Crazy. I'm like, it literally moves like gold.
Yeah. Now remember that the chart of a yield is inversely correlated to the bond. So what does that mean for Japanese bonds? They've been absolutely getting smoked. Okay. So why, again, why is that significant? It's because of Japan's role in the global economy as both a debtor and creditor nation. Right? That's a very significant role. And when you don't have demand for a country's bonds, this isn't like a completely one-to-one analogy, but that's basically people not buying that country's stock anymore.
Yep.
If this was the US, we would have a full-blown financial crisis in our hands right now.
Yep. Complete. Oh my god! I always like to think of it from a monopoly point of view, right? When you start the game, and the bank has all the money, and it starts, lending or giving out money to all those people, so on and so forth, and the economy's going great whilst there's money in the bank. But the moment the liquidity dries up in that monopoly bank, then it starts getting a little bit crazy. People have to start selling their properties in order to, facilitate other players, and then players will start to slowly lose because there is no more liquidity that's out there that the bank can provide to save them from, and carry on playing. And that's, and it's a weird analogy, I know, just Monopoly game, right? But that's how I think of the market. Essentially, we're in this big, massive Monopoly game where everyone's, no, I say everyone, the rich people are really happy because there's a quote unquote infinite amount of liquidity coming through. But we are seeing that the market is slowly saying, hold on a second, there isn't enough money to go around for everyone. Something needs to break. And the first thing that usually gives signs is bonds and yields. And then, the market follows through after that, right?
Yeah. I mean, the bond market is so incredibly important. Don't have enough time left today to get into all of that, but yes, like the answer to what you're saying is absolutely yes.
They call it the smart. Is it no? Yeah, they call it the smart money, right? The smart money guys.
Yeah,
Um,
yeah, it's different though. Like, so that I can explain. The reason that kind of, and it is true to a large extent, the bond market is smarter than the stock market. How many retail traders plow into bonds, right? Like they're meme stocks. Nobody.
yeah,
So the stock market is de facto just so much more emotional. Okay, it's a much
yeah,
more emotional vehicle for market speculation,
yeah,
whereas the bond market is really very nerdy and quantitative and deliberate. Not, and I mean that in a complimentary way to you fixed income traders and analysts. Uh, I will say this: scalping bonds is a beast of a job. I have so much respect. If you are a fixed income scalper working on the institutional side, the amount of dollar volume you will push through in a year, as far as what your positions are worth, is literally shocking. Like it is off the charts shocking. So if you are a fixed income scalper working on the desk of a tier one institution, you are an apex predator in this game.
yeah. You almost have to be sociopathic in a way. And again, I'll take it as a compliment. Someone
Yeah,
said that
I
to me.
can't. Yeah, I'll be the first to say I cannot do that. I can't do that.
Yeah,
I do not have it in me to be that, in and out with that kind of size that many times over the course of a day. It's ridiculous.
yeah. Yeah, so that's what me and Imre for the most part mean when the bond market's the bond market is falling and the yields are rising and it's inversely correlated at a relatively fast pace. It definitely shows that canary down the mine that something's not right. Because I'll say the last thing those traders do is trade with emotion. There is no emotion. It's just statistics, volume, value, and yeah, the dollar sign at the end of it. So yeah, if you start seeing spikes in both before you start seeing that slowdown in the stock market, then yeah, definitely watch out for those. Um, but yeah, apart from that, anything else that we can go through, Emre, today, or
I think that's about it, my friend. Market opening bell just rung. I've gotta get out of here.
yeah, no worries. Well, listen, it's been a pleasure